The gold traders believe it. I think that's the main reason that gold is still 4,000, 4,100. It's because of the expectation that the Fed is going to be hiking interest rates. The economy is weak. The housing market is weak. The last thing that the markets could survive would be rate hikes. In fact, that's the main reason that the rate hikes were called off in the first place. But the goods deficit was $106.5 billion. That is enormous. One of the worst goods deficits we've ever had. Trump was supposed to fix that with the tariffs. If our trading partners can now use AI to perform services that Americans used to perform, well, those Americans are out of work. We have deficits because the public wants things. The public wants health care. No, that is not the job of government. People say, well, the people want housing. Well, how are they going to get housing from the government? The government doesn't have any housing. Elizabeth Warren said that the big, beautiful bill was the rich robbing from the middle class and the poor. You have to do something. The Fed can't just talk about hiking rates. It's going to have to actually hike them. And if it doesn't, there goes what's left of the Fed's credibility. So the markets should be weaker. The stock markets should be a lot weaker right now with this threat, unless nobody believes it. But the gold traders believe it. I think that's the main reason that gold is still 4,000, 4,100. It's because of the expectation that the Fed is going to be hiking interest rates. That's why the dollar index is 101. The dollar rose based on the expectation that the Fed is going to be hiking interest rates. If it doesn't deliver these hikes, that amounts to a cut. In fact, it amounts to a big cut. Even if they do hike, it's a cut because they're not going to hike as much as inflation is rising. So real interest rates are going to fall. I've been hammering this point for months and months on this podcast. Investors don't seem to get it, but it doesn't matter what the Fed does on rates, because even if we get 325 basis point rate hikes, that's 75 basis points. That's nothing. Inflation is going to be a lot higher than that, above what had been anticipated. And so real rates are going to go down, even if nominal rates go up. But the problem is we have so much debt, the economy, the labor market. I went over how bad the jobs numbers were that we got on Thursday on my last podcast. But the labor market is weak.
The Fed keeps threatening higher rates, yet markets behave as if the warning carries no consequences anymore. Peter Schiff notes that even 3/4 point hikes would still leave real interest rates underwater if inflation accelerates faster. That disconnect explains why gold remains resilient despite a firmer dollar and hawkish rhetoric. Savers should watch purchasing power, not headline rates. Next, Peter Schiff exposes why the Fed's toughest language may actually signal its weakest position.
The economy is weak. The housing market is weak. And the last thing that the markets could survive would be rate hikes. In fact, that's the main reason that the rate hikes were called off in the first place. That's the reason that when Powell was president, that they cut interest rates. It wasn't just to try to help re-elect Biden or to elect Kamala Harris. It was because banks started to fail. It was because the economy was at risk because of the enormity of the amount of debt that we have. And our debt problem is getting worse. In fact, look at the trade deficits that just came out. We got the report on the June trade deficit. The unified trade deficit came up, the May deficit, and we had a huge increase from the prior month, 42% rise in the trade deficit. The prior month was $54.6 billion, and May was $77.6 billion. Now, that was actually a little less than the markets expected. So the markets expected a huge increase, and we got a huge increase. And that huge increase was driven both by a 3.2% drop in exports and a 3.3% rise in imports. So On both sides, it got worse. And in fact, if you just look at the goods trade deficit, merchandise for the month of May, because we do have a surplus in services, but the goods deficit was $106.5 billion. That is enormous. One of the worst goods deficits we've ever had. Trump was supposed to fix that with the tariffs.
Trade deficits are exploding while policymakers keep insisting the economy remains fundamentally strong. According to Peter Schiff, a 42% monthly jump in the trade deficit reflects structural weakness that tariffs alone cannot repair. Rising imports alongside falling exports suggest domestic demand is being financed by mounting debt rather than productive growth. That combination quietly erodes a long-term purchasing power. Next, Peter Schiff reveals why this trade imbalance could force policymakers into an impossible monetary choice.
And once again, I said this from the beginning, that the tariffs would not work, and they didn't work. They didn't work during Trump's first term, and they're not working during his second. During his first term, he campaigned on lowering the deficits, the trade deficits. Yet the trade deficits hit record highs during Trump's presidency. I predicted that would happen. I said the tariffs would not have an effect, that the trade deficit would keep getting worse because the tariffs did not attack the disease, they attacked the symptom. And by doing that, they let the disease get worse. The same thing happened this time. The tariffs did not result in a manufacturing renaissance. The manufacturing recession continues during Trump's term, and we continue to get more and more dependent on foreign manufacturing. And by the way, where AI is going to make a big difference initially is going to be in services. A lot of the services that America now exports, a lot of our customers may no longer need those services. They may be able to have those services, those functions fulfilled by AI. And so if we don't have to perform services because foreign companies could use AI to do the services that American workers used to provide, well, the deficit is going to get a lot worse because our surplus in services is going to shrink. And so is the employment in the service sector, because a lot of jobs are a function of services that we export, not only services that we consume domestically, but our trade surplus in services. Well, if our trading partners can now use AI to perform services that Americans used to perform, well, those Americans are out of work.
Tariffs promised industrial revival, yet the underlying dependency never disappeared. What Peter Schiff is highlighting is that trade policy cannot solve structural competitiveness, while manufacturing contracts and AI threatens America's service export advantage. The official success story ignores that future job losses may come from software instead of factories. Investors should question growth assumptions built on fading service dominance. Next, Peter Schiff unravels why Washington's manufacturing narrative ignores an even larger economic vulnerability.
One of the main reasons that we have such big budget deficits is that politicians, want to get elected and they want to give the public what they want. That is the inherent flaw in democracy. And it's the reason the founding fathers created America as a republic, not as a democracy. It's not like democracies didn't exist. The founders were very familiar with democracies and their history of failure. And the experiment that they launched in the United States was self-government as a republic, hoping that we could avoid the pitfalls of democracy. We have democratic features of our republic, but in general, the purpose of the republic is to protect the minority from the majority. But the reason I was thinking about this is I was watching on CNBC, and there was like a on-air debate going on between this Steve Leisman, who is the senior economics reporter, and Rick Santelli, in CNBC. And I've known Rick for a long time, and Rick's a good guy, although I don't always agree with Rick, but I appreciate his enthusiasm and his sentiment. And a lot of times he is right about things. And in this particular argument, he was right. Leisman is rarely, if ever, right. But what they were arguing about, and I didn't even see the whole thing, but at one point, Leisman said, well, we have deficits because the public wants things. The public wants health care. And therefore, according to Leisman, the government has to provide that health care because the public wants it.
Budget deficits rarely shrink because political incentives reward spending long before consequences appear. Peter Schiff's argument suggests the debate isn't merely about economics, but about expanding government obligations beyond sustainable limits. Markets often ignore this until debt servicing overwhelms fiscal flexibility and monetary policy follows. Wealth preservation begins by recognizing incentives, not campaign promises. Next, Peter Schiff exposes the contradiction between political promises and the financial reality funding them.
No, that is not the job of government. I went over that on my podcast before Independence Day, that the government is not there to provide us with the things that we want. The government is there to secure our liberties, to secure our rights. We don't have a right to health care because you can't have a right to something that imposes a responsibility on someone else. If I say I have a right to health care, well, then what doctor is my slave? Right? I'm going to use the government to enforce slavery and so that people will give me health care. No, you don't have the right to take anything away from somebody else. Rights exist on their own. The government secures your right to go out and pursue health care, meaning if I want to try to get health care, if I want to buy health care, the government has no right to interfere. Although that's what our government does all the time. They interfere with everything. There's all sorts of rules and regulations that limit my ability to buy the health care that I want because the FDA has to approve the drugs. And if the FDA doesn't approve it, I can't buy it, even if I want it. See, we've got it all upside down. We actually destroy rights when the government says you can't choose. You can't buy what you want. You can't use the drugs that you want. But we're gonna give you free health care. We're going to provide you money so long as you consume the health care that we deem is appropriate for you. But that is not the function of government. Yes, people want health care. They want a lot of things. People want all kinds of stuff. That doesn't mean the government is supposed to provide it.
Every new entitlement carries a cost that eventually surfaces through taxes, debt, or inflation. This is where Peter Schiff's thesis shifts from political philosophy toward economic incentives, arguing that expanding government control often reduces individual choice while increasing financial burdens. Investors should remember that persistent fiscal expansion usually pressures currency purchasing power over time. Next, Peter Schiff reveals why growing promises often end with shrinking money.
Government is supposed to stay out of the way. Because again, the government doesn't have anything. People say, well, the people want housing. Well, how are they going to get housing from the government? The government doesn't have any housing. How would the government get housing? Well, they'd have to hire people to build houses. Well, where would they get the money? They'd have to take it from the private sector. So either they have to engage private contractors, they have to take money from the taxpayer and then pay it out to a private builder. But why interject the government? If the public wants houses, let the free market provide housing, because that's how capitalism works. People know, gee, people need houses. If I make houses and sell them, I'll make some money, right? People need shelter. That's how capitalism functions. The capitalist identifies a need, and he tries to satisfy that need because in the process, he can get rich. He can make money. But he only can make money if he satisfies needs efficiently and economically. He has to be able to satisfy needs by using fewer resources than the consumer would value them. So I have to be able to use land, labor, and capital to produce a home that somebody is going to want to buy because they're going to value the home at more than the cost of building it. The difference is the reward, which is the profit. I built a house at a price that a consumer saw value. And obviously the house is a big example, but every product, clothing, food, whatever there is, as a businessman, I am motivated by the needs and desires of my customers.
Housing affordability keeps worsening despite years of intervention meant to solve it. Peter Schiff notes that governments must first extract private wealth before redistributing resources, creating additional friction instead of new supply. Markets function through incentives, while policy often substitutes bureaucracy for price discovery. Investors should watch where capital flows, not where political promises point. Next, Peter Schiff exposes why housing shortages persist despite expanding government involvement.
If I can satisfy those needs and desires and I can do it efficiently, then I can make money. And so we have all these entrepreneurs trying to give the public what the public wants. Now, not for free. Obviously, the public has to buy what it wants because it has to pay for the resources that are needed to produce what it wants. Because if nobody had to pay for anything, well, then there'd be nothing. Because the people who are my customers are also themselves producers. They're working. Either they have their own business or they're an employee for somebody else. They are collectively contributing to all the economic output. And so they get to spend in proportion to what they helped produce. So their purchasing power comes from their own efforts, their own contributions. It just doesn't come out of thin air. But when you try to interject the government, when you try to say, oh, the government is there to satisfy the demands that the people have, how are politicians going to satisfy anything? There's no profit motive there. They're not running a business. All they can do is steal money from one person and give it to somebody else. And so when you assign government the task of satisfying the demands of consumers, they don't do it nearly as efficiently. So you waste resources. But more importantly, too, you destroy individual liberty. You become destructive of the very means that government was created. Government is there to secure our rights and our liberties, not to give us stuff, but to make sure that we don't lose the stuff that we have, the stuff that we earn. I was reading, on X, about the wealth tax and all this.
Economic output always comes before purchasing power, never the other way around. According to Peter Schiff, governments can redistribute existing wealth, but cannot create lasting prosperity without productive investment expanding first. That distinction becomes critical whenever deficits grow faster than real output. Long-term investors should focus on productive assets instead of policy headlines. Next, Peter Schiff reveals why expanding government spending often masks declining economic productivity.
I was at maybe a Elizabeth Warren post, and she was, she was talking about the big, beautiful bill. And she was speaking critically of the big, beautiful bill. And I agree with her. I was critical of the big, beautiful bill, but for the wrong reasons. Elizabeth Warren said that the big, beautiful bill was the rich robbing from the middle class and the poor because they got the lion's share of the tax cuts. Because more of the tax cuts went to the rich than to the poor, she considered it legalized theft. As if the wealthy people keeping more of what they earned somehow constitutes theft. I mean, think about where we've come. So if I want to keep my money, I've stolen it, the money that I earned, the property that I own, if I object to the government taking my property, then I'm a thief. No, it's thievery that I object to. The thieves are not the people who earn the money. The thieves are the people who want to take the money. There's nothing wrong with wanting to keep what you earn. your property. That's human nature. That's the whole American system about private property, about not having your private property taken away from you. And just because the government has the right to tax us, they can't tax us to take our money and give it to somebody else.
The loudest political arguments often distract investors from the deeper fiscal trajectory beneath them. What Peter Schiff is highlighting is that debates over taxation frequently ignore the long-term effects of persistent redistribution on capital formation and investment. Institutions monitor incentives because capital eventually follows policy. Savers should pay closer attention to where investment is discouraged. Next, Peter Schiff exposes why tax debates rarely address the currency consequences they create.
They can tax us for the general welfare of the country, not the specific welfare of an individual. They can tax us to cover, the military and stuff like that, but they're not allowed to redistribute wealth. The Constitution was written specifically to prevent the government from redistributing wealth. But according to Elizabeth Warren, if you don't want your wealth redistributed, then you're stealing, right? Anything that you don't let the government take from you is money that you stole. No, the thieves, right? She never calls people on welfare thieves. They're not stealing money. Of course, they're getting money that was stolen. They're the recipients of stolen money. But they voted for the thieves. They're the accomplices to the crime. They're the thieves, not the people that earn the money. And by the way, how did they earn that money? Right? They created businesses. They produced products. They provide services. They created jobs. They added a lot of value. And in exchange, they earn money. And the fact that they want to keep more of that money does not make them a thief.
Political language can redefine incentives long before economic consequences become obvious. Peter Schiff's argument suggests that framing wealth creation as exploitation risks discouraging the very investment needed for future productivity and employment. Markets ultimately respond to incentives rather than slogans, regardless of election cycles. Investors should separate emotional narratives from capital allocation realities.